Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for August 9th, 2022. Wanted to cover corn and soybeans here. We've had some good movement after some crop condition reports yesterday came out with lowering the good to excellent ratios. We'll take a look at that in a second. And of course, give you some updated numbers here on where trade expectations are for the WASDE report coming this Friday. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trading recommendation. But my contact information is available to you, 312-277-0110. Find me at Dan Hussey, SOTD, here on Facebook. Shoot me an email, dhussey@zaner.com. We can always discuss in more detail how we can turn these ideas into a trade plan. Also, feel free to sign up and join me for the Strategy of the Week webinar every Thursday at 2 p.m. Central, where I go into more detail on some of these ideas I talk about here today, present trade ideas and how they can become actual trading ideas and strategies for you. And that sign-up link is available in the comment section and information sections below. All right, so today, let's begin by taking a quick look at our U.S. soy conditions report. This information from Karen Braun from Reuters at KANNBWX on Twitter. Thank you, Karen, for all the work you do compiling this data and getting it out to all of us, that we're all slaves to your reports here. Soy conditions across the country dropped 1% in that good to excellent ratio from the July end of July report, last week's report that we got. The I states kind of mixed there, which was one of the big changes here. And of course, Michigan's drop of 7%, as of August 7th, was a pretty substantial change from last week as well. Michigan actually had one of the more favorable conditions going into this last week, and obviously dropped down below 50%, good to excellent. Not very good, and probably a good reason why soy is starting to take over, as well as our export figures. We've seen some flash sales and some good export data over the last week. China getting on the books again, and it raises questions as to how much South America might actually be able to export at this time of year, considering China's coming to the plate earlier than we usually anticipate. A pretty good look for U.S. production at this time. Corn conditions also dropped a whopping 3% there in the good to excellent. I states still very mixed there, with North Dakota and Kansas dropping significantly, both Dakotas dropping significantly along with Kansas. Those western plains really not faring well, unfortunately, and not getting really any or much of, if anything, of the rains that we have seen as kind of relief here over the last several weeks for much of the rest of the country. So trading this week starting off with a kind of bullish undertone to it, given the drop in conditions across the country. And a lot of this was probably factored in to the trade already. But when you add on export expectations being a little bit better than maybe expected, coupled with a report coming out this week, we could see an interesting move into that report. And as I mentioned there, we've got the U.S. crop production estimates here, compiled by Reuters and taken from a survey of analysts and institutions, including Zaner's own, in numbers in these figures. The average corn yield dropping to 175.9 as expected, in comparison to 177 from the July report, over a point drop there. Anything below 175 would certainly be considered bullish against the trade's expectation. Yields dropping to 51.41 in soybeans, almost a half-point drop there. Kind of, very early, obviously, I think, to really start honing in or saying that those are the yields we'll see for soybeans, given that we still have several weeks left of the plant being able to produce. But still, those drop in conditions here being, I think, taken into account into this next WASDE report with the analysts' expectations for lower yields. Now, the big question, of course, and what is uncharacteristic of this August report, is that we do have a resurvey of harvested acres, and those planting intentions and harvest intentions, I should say, that are going to be resurveyed and will be re-released here on this report, which is uncharacteristic for August. But that also adds the USDA's ability to kind of neutralize this report or even make it a bearish report, based off of what they do with yields relative to those harvested acreage amounts. The last kicker in the hole in this report that we'll all have to be paying attention to is what they do on the demand side of the equation. And if they reduce demand on top of larger acres than expected, with yield cuts that aren't as big as expected, or maybe even in line with expectations, you could even drop a little bit on the yield still, and we still have less than tight balance sheets than we are currently anticipating. So gotta admit that this report isn't exactly a sure thing for the bulls, like a couple weeks ago when we were starting to consider what it could be with just a yield adjustment, knowing that acreage is still on the board and the demand side of the equation could be adjusted, could turn this report on its head. However, the trade so far this week has obviously been trading a little bit more bullish relative to last week. I wouldn't say that it is a complete bull market taking hold, but it is good to see prices, back above $6 for corn and certainly back above $14 and taking the pressure off that psychological beans in the teens idea for November beans. All right, beginning today's technical look here with December corn, went out the day at 614. Kind of a bad close if you really want to get down to it, closing down around where the gap up and open here today and in the overnight session was, leads me to believe that corn might be still have a little more sideways price action, but certainly while we have two open gaps left on the chart below us, there's also two open gaps left up in the chart above us. And being in the middle, generally speaking, in the middle of the range we've been in for the last month and a half, hasn't really, I think, taken the pressure off from the bulls. The 18-day moving average right at $6 has been, a supportive area here in the near term for the December corn, but we are continuing to find resistance up into that 200-day moving average at 625 quarter. That's the threshold that I would personally need to see this market trade back above, close above, to say, okay, we're on our way to a test of that 55-day and 100-day moving average, back up to maybe the 50% of the entire decline from contract highs to the recent lows, which is around 666. So while I feel we're in a period of price discovery higher for corn, you can't rule out that these technicals aren't giving us much to chew on for a prolonged bull market at this time. But there's certainly levels to pay attention to, like 625, that 200-day moving average. A close back above that area would be a bullish signal for funds and probably lead to a period of price discovery and a reversion to the mean higher towards that 55 and 100-day moving average that we have above. On the smaller time frame chart here, let's start with the 4-hour to kind of break down what corn's been doing over the last week or so, leaving an open gap down at 584 quarter, a level that we gotta be aware of, that certainly could try to close that gap at any moment. And then, of course, from last night's open at around 607, two areas on this chart that we need to, 607.75 to be exact, two areas in the chart we need to be aware of. At the very least, corn has started a kind of stair-stepping higher today and yesterday in a move off of its lows. We broke the 50% retracement, or the 61.8 line of that 50% today on the way back up. But like we looked at, and we will look at on soybeans here in a minute, sometimes that 61.8 line break isn't exactly a bull signal either. In this case, we came down here on Wednesday of last week, traded down to 590 and hit that 61.8 line of a 50% pull from the 561 lows to the highs after. Now we've broken the 61.8 line on the other side. That to me immediately causes me to draw up trend lines against highs and lows and start at least considering the idea that we could be sideways in a wedge or sideways price action. There is at least the hope now that off of the low from last Wednesday, we did hold a 50% pullback from 615 down to 601. We traded up to 621, up into its target. Next in the series, from the entry lows of $6 up to the 624.50 highs of today, is precisely where support today at 612.5, the gap support, and that 50% line came into play. You could draw trend lines against the lows and make an argument that there's another little trend line here that started from last week through the lows on Monday that also comes in around 610 and right around that gap fill. So definitely some support to consider here between 612 to 608, kind of tight, 4 cents. We've been in fairly tight trading for corn, but those levels are there, and certainly as of today's close, we're holding. But going into tonight, I would want to see pretty much the bulls pick it right up off of the floor and head up towards 630 to feel a little more confident in this trend we've begun off the lows. Otherwise, falling back down to 608, certainly back down to $6, just to me says we're in a larger range for corn that we've been in, and that 584 gap below us, is still it's still a threat of being filled at this time. Back above 625, as I mentioned before, the 50% retracement off the big highs to lows here, 766 high down to the 561 lows, comes in at 666. Could be an area to target to the upside, as well as an open gap at 673 that we've left open since middle to late June there. Taking a little bit of a step back on the corn, just a reminder from the contract low to contract high for December corn, that 567 area, that 50% supportive area, is the larger daily or weekly support that we seem to be holding at this time and flagging above. So, I'm bullish above, bearish below, kind of that figure going into, the longer term. But on the short term, when we get down to the 15-minute and our sub 4 hour charts, those intraday charts, we really need to see corn pick itself back up, get through the highs of today to have some real confidence that this this bullish trend we've seen since last week will continue, and that we're not just falling back in the range that we've been in. So yeah, it's up to the bulls to kind of give up here, and there's some levels to defend. Really want to see it stay above this trend line and above that 608 gap at this time. We'll see how corn trades the rest of this week. Soybeans leading the way today for our row crops, up 28 3/4 cents in the November contract. Also, threatening a sideways type of price action at this time. We'll get into that in a second. The 200-day moving average been a little supportive, along with that 18-day, kind of the supportive area on this chart between 1391 and 1383 at this time, respectively, for that 200-day and 18-day moving average. Resistance has been up at the 55 and 100-day moving average, which now comes in around 1445 and 1464. So got a 60-cent range for soybeans that we've been inside of, and arguably we are right in the middle of that range at this time. The reason that I suggest we could see continued sideways price action in this, range, which really extends from $13 up to, $15, a $2 range on soybeans, is because that contract high from 1584 high down to the recent 1289 lows from July, we traded up to and broke that 1472.618 level. You see it purple on this chart, highlighting that. So now it turns blue, so you can kind of see it. No respect from the 50% line, went right up to the 618 line, but then fell apart. At that point in time, we had left an open gap at 1349.25. That gap is still open, and we left a gap here today at 1402. So much like corn, beans have left two open gaps below us, and I would say that those two gaps are pretty correlated to each other. That if we're going to fill that 1402 gap on the beans, we'll probably fill that gap from overnight on the corn as well, down around 608. And if we want to fill the gap down around 584 on the corn, we're probably going to fill that gap at 1349.25 on the soybeans as well. On that move that we had from 2 Fridays ago, off the 1489 highs down to the 1356 lows, we also broke 618 lines of any kind of 50% long or Fibonacci retracement you draw up off that low. And once I get a 61 8-line break of a range in both directions, I immediately start drawing up trend lines against the highs and the lows and start considering the idea that we're in at least sideways price action for the time being. And that seems to be the case for soybeans here today. We traded off of the lows of last week and the lows of August from 1356. Today we went up and hit that 618 line of the 50% retracement, or the Fibonacci retracement from the highs of July down to the lows of August. Now, I wouldn't be shocked to see soybeans trade all the way back down to 1380 to break the the 618 line of a fib pull from the lows to the highs thereafter. However, like corn, and I'm just going to remove this one fib off the chart for a second so that we can look at what soybeans done in this last week of price action. From the 1356 low to the 1428 half high after, we did hold the 1392 50% retracement. Upside targets at the negative 23.6 line of 1445 seem to be where the market was heading here today. We broke downward sloping trend lines of this little consolidated range, and arguably the market even held a 50% retracement on its day at 1423. But like beans or like corn, we're going to have to see and want to see beans kind of pick itself back up here in the overnight session, push up into through highs, and certainly try to make a run for that 100-day and 55-day moving average above us for this market to really continue the arguable bull trend we've seen since last week's low. Next in the series would be drawn from 1391s up to the highs thereafter if we get there, but with an open gap, two open gaps below us, we wouldn't want to see, as you know, from a bullish perspective, either one of those levels fill here if the market's going to continue higher in the near term. But again, you take a step back outside of the 15-minute chart, you look at what we've done the last month or so, and both of these markets still look very much caught in ranges, at least though with some bullish undertones right now, where if you are long or you're looking to be long or you've had a long bias, you don't need to necessarily throw that towel in yet, because there is certainly still some things on these charts and fundamental reasons to think that these trends could continue. But that also comes with the caveat of being cautiously optimistic about that trade, because the ability for these markets to trade back down in the ranges we've been in is just what ranging markets do. So with that being said, we'll see if the market can pick itself up tonight, if we can finish strong here into the end of the week and into this WASD report. And from there, we'll probably have a lot more clarity. And I imagine that coming out of this week and getting through this WASD report, we'll probably see these ranges get tested or break to one capacity. And it was about this time last year where corn actually started its uptrend that lasted all the way through March. It didn't go straight up. It was a stair, took the stairs up through October and into November. And it wasn't until soybeans really found their bottom, which, by the way, still, if this was soybeans last year, we could still trade down into the $12 handle, into November before finding that low. And all those things, you got to kind of keep perspective on the bigger picture. And certainly when we have larger ranges at play, even though we're in a period of price discovery higher on the intraday chart, it comes with some caution that the bigger charts also suggest that we're more range bound than not. Other things of note here today and last week in the Strategy of the Week webinar, I was talking about our protein premium, the KC Chicago wheat spread here, still trading this upward sloping channel here. Came off the lower bounds of that channel around 55 cents over. Closed the day with an outside day to the upside here. Tomorrow, if we can push through that 60 cents over, looks like we'll be back on our way towards 68 to 70 cents over. And this turn in the wheat spread for KC Chicago might be an early canary in the coal mine for the general wheat complex trying to find a bottom. But as I pointed out last week, this spread also bottomed in July far before wheat found any kind of floor. Wheat still fell $1 or $2 while this spread was actually heading higher. I think that is just a show of the valuation of that KC wheat on the international market, where we're not getting as much of hardwood winter out of the European markets and out of the Ukraine as maybe initially anticipated. So we'll see what happens. But I do think that today's close was a good technical reversal off of off of a trend channel here, and expecting this market to trade now back to highs of the month, at least for the KC Chicago spread. We'll see what happens. All right, well, that concludes today's Strategy of the Day update. Join me every Thursday at 2 p.m. Central for the Strategy of the Week webinar. Those sign-up links available in the comments section and the information section of this video below. Look forward to hearing from you guys. Leave your comments below. And with all that being said, have a great day, everybody. And I will be back with you as price action develops. Take care, everyone.
You got the 1470 October soybeans that are actually short to